We've had quite a lot of economic data, and I think one of the most important things that we have to keep in mind is the interest rate differentials that we've been seeing globally. We saw India hiking rates, Malaysia also hiking rates, the Fed keeping rates unchanged, and of course the inflationary scenario that is playing out globally doesn't seem to be consolidated. Of course, we are seeing different numbers coming through on a global level.
Sure, I mean, you know, all those economies are going through very different things. I mean, if you look at Asian economies, you know, the dip that you saw as far as the recession is concerned wasn't as bad as that you saw in G7, excluding obviously China. You know, and the issues that they're dealing with in the very big Western economies are very, very different to what you deal with in Asia and the rest of the emerging market space. So therefore, you start seeing people hiking rates because inflation is becoming an issue in those countries, and in certain cases where they don't do inflation targeting, they're in essence sitting in a situation where they're saying, well, our economy is starting to grow, let's start hiking rates to try and just keep this growth in check so it doesn't run away with us. Whereas if you look at your big Western countries, they're still sitting with trying to just kickstart, you know, their economies. They're trying to just get the beginnings of inflation going, trying to get GDP numbers into the positive territory. Although we're seeing a turning point, you know, we're not seeing rates moving yet in those economies.
Exactly. Just looking at the US, because we haven't actually seen economic growth catching up, and we know there's been quite a lot of stimulus. Luckily, we're still seeing a deflationary environment there. But if we do see inflation coming to the fore, it's going to be difficult to balance growth and inflation and ensure that the stimulus doesn't result in hyperinflation.
Yeah, I mean, The Economist wrote a fantastic article about this a while ago, where they said, well, in the crisis, it was fairly obvious what you should be doing. Well, you know, if you go back 50, 60 years, it wasn't that obvious, but today it seems pretty obvious. But now that it's been done, and now that you've actually stimulated the economy, the question is, what do you do from this point forward, and what is the correct response from this point forward? Because you're starting to see GDP growth. At what point do you start hiking rates, and how does this look? You know, if you look at the Federal Reserve, you look at most of their advisors, you look at the Federal Open Market Committee, they're fairly conservative as far as rates are concerned at this stage. You know, they've gone through a major crisis, and on the back end of that, it'll obviously be imprudent for them to put up rates right now, but certainly, you know, into the future, maybe 12 months down the line, especially when they start seeing growth coming through in that economy, you'll start seeing, you know, rates hiking. Then we don't expect fireworks from the American economy. You know, they're sitting with huge issues. Like, for instance, look at this healthcare reform. You know, the emerging market.
Do you think it's a good thing, though? Because some say that it wasn't great before this reform, and now because they've put this in place, it's actually going to cause even more problems.
The last time around the Americans thought about healthcare reform was 2 decades ago. You know, you do business in an emerging market where you're part of an emerging economy. You kind of look after yourself. You know, you got to get yourself employed to make money. You got to look after your own healthcare. You know, government will provide some form of base, but the whole thing is pro-growth. It's about opportunity. Whereas if you sit in your very big Western countries, you know, with a massive base and massive middle class, you know, suddenly the priorities become very, very different. And this is just one of those priorities. You know, the last time around the Americans thought about healthcare reform was a couple of decades ago. You know, this is certainly something that they've been talking about for a long period of time. And obviously, Obama, this is part of what Obama said in order to get himself elected, and obviously in it's necessary for a big overhaul.
Of course, it's a tough one, and something even tougher. We know that Bernanke, Fed chairman, is going to be talking about possible exit strategies from all the stimulus that we've been seeing, and of course the quantitative easing as well. What are you expecting there? Do you think we'll be seeing more stimulus coming to an end during 2010?
Well, I mean, already Obama in his speech to the nation spoke about no fiscal stimulus beyond, I think it's next year or the next year. So he's already started paving the way for the government to start contracting, and for the consumer to continue to start spending again, so that they can start recouping some of the money that they've spent. So that's part and parcel of prudent management as far as an economy is concerned. The question is, how quickly can they remove this? That's the real question. And I mean, that's what many commentators are talking about today, is how quickly can one remove the stimulus without having a lasting impact on the economy.
Turning our attention to South Africa, quarterly bulletin out yesterday, current account deficit sitting at 2.8%, far better than the plus 3% that most economists had expected. We know that the consumer also looking slightly better, which was quite a surprise, which perhaps means that we are starting to put oil into our engine.
Yeah, I mean, if you look at all the data that came through, from the bulletin, all of it is either better than expected or it's at a cusp of a turning point, so it's not worse than expected. If you compare some stuff to December year-end sales and so on, or year-end numbers, some stuff looks slightly worse, but it's not like it's much worse than what we saw before. And I mean, that's obviously good news for South Africa, and that's really not only a story for South Africa, but it's a story right across all the other emerging markets. You start seeing this rebound as far as the economy is concerned. The question is, if you look at the valuation in the market at the moment, what does that tell you relative to the economic data that's starting to see coming through? Because we're not seeing, it's going to take quite a while still, maybe another 6 to 12 months before you start seeing economic data transcend itself into earnings. I mean, one has to watch that quite carefully to see what happens to the valuation of the
Those
market.
highly anticipated inflation numbers set to be released today, and some say we could see a little bit of surprise to the downside, which could we perhaps see an interest rate cut tomorrow?
Who knows? Who knows? As you know, I don't predict markets. I'm not a very good predictor of these things at all.
Would it be wise if we do see something to the downside that we cut again?
Remember that firstly, the MPC looks at data that is available to them in the market at the moment. So they don't try and predict these things. So they don't sit down and say, well, we think inflation could potentially be in 3 or 4 or 5 months' time, be below the 6.2, 6.3 level that it is at the moment at say 5.5 or 5.2. They look at the data that comes out right now. And already, inflation is bouncing at the top end of the target band. If it drops below at 5.8, the gap at the moment between inflation and the repo rate is only about 0.70%. How much more can you potentially drop this? If you drop this, maybe you've got a 20-point gap. 20-point gap when inflation moves up, suddenly you're slightly out of the target band. It's semantics at the end of the day, but it's pretty low as it is. And as a matter of fact, if you take the 7% into consideration, repo doesn't, in the last 15, 20 years, repo doesn't drop much further than 7%, in a South African economy situation.